All right, after a drop yesterday, let's see if we can rally back up today. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, beats across the board for Morgan Stanley in the third quarter. And next hour, my interview with CEO Ted Pick.
And chip indigestion. Intel gets hit with a double dose of bad news, and a tepid outlook from ASML sparks a global rout in the sector.
And Trump's beautiful tariffs, his words, not mine. Former President Donald Trump defending his plans to overhaul the U.S. economy in a Bloomberg News interview. The latest on the road to the White House. All of that and more coming up. But let's take a look at where markets are trading with 30 minutes until those bells ring. Pretty quiet right now. Of course, we had wipeout yesterday when it comes to the S&P 500, when it comes to the NASDAQ 100. You think about that chip indigestion that Matt was talking about, shaking it off at the moment a little bit higher pre-market, and I stress a little bit. And then you take a look at the bond market. You saw a big haven bid yesterday. Some of that buying momentum continuing today, pushing 10-year yields down to 4.02%, Matt, but still above 4.
Shake it off. Shake it off.
That was pretty good.
It's going to be hard for ASML. Look at this chart. The worst drop in 26 years. It's only been a publicly traded company for 28. Tepid is a very nice way of saying that bookings were less than half of what analysts predicted. An absolutely huge miss, and it's going to be difficult for the entire chip sector to shake that off today.
There are some other things shaking things off on the upside. I don't know. We're looking at some stocks under the surface. Morgan Stanley now up nearly 4%, up 3.8% pre-market. Sales and trading revenue beat estimates in the third quarter, and assets under management topped $7.5 trillion. Watching Novavax as well, down after the company said the FDA has placed a clinical hold on its application for a COVID-flu combination and standalone flu vaccine candidates. Down 16.3% pre-market. Intel also dropping after sources told Bloomberg that Qualcomm is likely to wait till after the election to pursue a bid for Intel. Intel down now more than 1.4%, Matt.
All right. A lot of chip stocks we're going to be talking about today, but really none matters as much as NVIDIA. Right. Yesterday it was down 4.7%. I think that made up for 42% of the S&P 500's drop. I was reading DataTrek's note today.
That was an ouchie.
It's just a massive, massive company. It's actually bigger than all but 2 countries in the MSCI World Index.
As NVIDIA goes, the rest of the market goes. We saw that yesterday, but it wasn't NVIDIA that started the fire. Of course, it was ASML. Just amazing. Of course, their third quarter bookings coming in at less than half of what analysts had forecast. It'll be interesting to see what TSMC reports tonight after the bell, but chips really in the sort of center of the market mind right now. Yeah,
and you think that you overlay it with what's happening in the geopolitical and the political as well. That fact that Intel, any deal might be on hold until after the election cycle just puts a whole cloud of uncertainty, especially as the Biden administration starts to clamp down on where things are sold as well.
Right, if Qualcomm's going to make a deal, they should wait till after earnings, too, because if it's a disappointment, they're going to get a much better
valuation.
Get it in the bargain bin.
Let's talk about all this and more with Verdens Capital Chief Investment Officer Megan Horniman. Megan, a down day yesterday. Looks like we could rally again today. And frankly, we've had a pretty fantastic year. We are in the first week of the third year of this bull market. Do you think it ends up?
I think it'll be pretty sideways between now and I think the election. I mean, the only thing we really have right now is earnings. But getting past the election, I think that the market is what's proven to us in the past is, historically from election day to the end of the year, market returns tend to be relatively muted. I think we can end up for the year, obviously. We're up in the double digits right now. But I think it's going to be after the election, I think it's going to be a much more volatile path to the end of the year. There's a lot of uncertainty, not only from, like I said, the election side, but then also the Federal Reserve as well. What can they do at that November and December meeting?
And Megan, I'm looking through your notes. I love this line. Be thankful for price to earnings multiple expansion. And I mean, this is something we were talking about yesterday. I think it was Mike Wilson who made point that this whole rally has just been built on multiples expanding. Interesting to see you coming out and saying maybe that's not a bad thing.
Well, if you look at the total return over the past 2 years, the majority of that, I think over 70%, has been made up of PE expansion. That's, be thankful for what you had there. We're not so optimistic that going forward you're going to see that type of PE expansion. You're entering, as we mentioned, the third year of a bull market. The returns tend to be relatively muted during that time. We're going into the first year of a presidential term next year, and what we tend to see is that's where you see the majority of recessions happen, in the first year of a presidential term. So I think that this PE expansion that we've seen, be thankful for what you've gotten thus far, but we're just not sure we're going to be able to, this can continue at that pace over the next year.
Megan, you had mentioned you think the market's going to go kind of sideways until the election, but when do you think that uncertainty starts to clear up? Is it through the end of this year, or do you have to wait until well after the inauguration, whoever it is, to know where the direction of travel is?
I think it's going to be into next year, but the bigger challenge next year is the economy. That is the bigger concern that we have right now. So is the Fed going to, what is the Fed going to be able to do to help the economy, and what are they not going to be able to do? So the two biggest drivers I think we're going to be watching when we go into next year is not only the economic side of things, but don't forget inflation. Most people have forgotten inflation, but what we've seen lately is that inflation that progress we've seen is kind of stalling. So these aggressive rate cuts that are priced into the market, how much can the Fed actually do into next year?
You're sounding fairly cautious, Megan, and I know we've come pretty far pretty fast. Where do you put your money if you want to be conservative?
So we are cautious. Look, over the long run, we're always going to like equities, and we're always going to be looking for, buying on the dip type of mentality when the valuation is right. What I mentioned earlier with the PEs right now, especially in the U.S. large cap space, are just way too high. It's way too expensive in our opinion. Instead, what we're doing is we're sitting with a healthy cash position, but we're looking outside of the U.S. as well. We've recently added some exposure into the developed international markets. We think over the long term, and we're long-run investors, that valuations there are historically attractive compared to the U.S. So take a look outside of the U.S. As we get through next year and we see what kind of, environment we are for the economy, take a look maybe at some small and mid-cap stocks. But there's no rush right now. Cash is not earning you what it was 3 or 4 months ago, but it still is earning you a decent return, that you have that flexibility to be patient, be diligent, wait for the market to give you valuations that are giving you enough reward for the risk you're taking on.
So still a fine environment to clip coupons in, sitting in cash. I hear you there, but let's talk a little bit more about that global view that you have, because a lot of focus has been paid to China. We've seen a lot of volatility in that market, of course. The finance meeting that we got over this past weekend, maybe disappointing some of the biggest bulls. When you're looking outside the U.S., even when you're looking to develop markets, how closely do you need to be paying attention to China?
You do. I mean, China obviously is a big impact, especially not only here, but in the developed markets. But the one thing that you have to look at that's more important to us is what's priced into the market. So is the market already priced in a pretty weak Chinese environment, and what that may mean for Europe and the UK? We think it has when you look at valuations. Also, we think from an international standpoint, we're focused more on the developed international markets, because as you saw with the UK inflation now dipping below their target, they're going to have more flexibility with interest rate policy than I think we do here in the U.S. to be able to help their economies.
Megan, it's interesting. I'm taking a look at just indices here in the U.S. as well. And one thing that I find fascinating over a three-month basis is that, yes, you have the S&P higher. You've had the S&P equal weight higher. You've had the Philadelphia Semiconductor Index over that time frame down 11%. How much is the weakness you're seeing kind of in that chip sector, semis, AI trade going to spill over?
I think you'll eventually see some of that spilling over, because obviously that's been what drove this market so high in this recent bull market. If you look at the 5 names that are making up about 100% of the total return that we've seen in the bull market, that can spill over. I think that there's just, people are shifting from the semiconductors going to maybe some other areas that have lagged, but don't forget that some of these other areas are also sensitive to the economy, and that's what we're concerned about going forward. So we think you'll see some more valuation correction across the board. Obviously, it'll be more concentrated in that tech and growth, but value even has caught up quite a bit now, so I think you could see that spill into that area as well.
First of all, Sonali, you know that Bloomberg style is indexes.
Actually, you're wrong.
Type style go on the terminal, and you'll see Matt Winkler, who invented Bloomberg
Oh my God,
News.
what a callback.
Secondly, you ask about chips, and we're sitting here on a day when we got more big bank earnings. Why don't you ask Megan about the banks?
Well, yeah, I guess, it's funny. Katie makes this point that the banks are only
13%.
13% of the S&P 500. That's all financials, actually, not just the banks. How much does the earnings from the banks, how much do the earnings from the banks really matter at this juncture?
I think they matter in every earnings season because it kicks off earnings season. So it's really that what's the view, what's the tone going to be for earnings season? And banks, they've done from the past few quarters. I mean, after the pandemic, they've really increased their loan loss reserves, and they've been kind of cautious on the consumer. They've warned of the increase in delinquency rates, and what we're seeing is they're starting to reverse that a little bit. I'm not taking that as a sign that the consumer's in fantastic shape. There is a report out yesterday from the Federal Reserve showing that consumers are the most concerned about being delinquent on a payment that they have been since the pandemic. So I'm not taking that as an overly optimistic thing, but banks are also notorious for overestimating net losses and then being able to come back as we get further into the economic cycle and take some of that back, and it actually works in their advantage when it comes to earnings. I think it's good. I think the banks, what we're seeing with the kickoff is great, but I want to get further into earnings season when we get, like we mentioned, the chips, some of the technology, and then specifically when we get to that retail side of it towards the back end of earnings season.
All right, Megan, always great to speak with you. That, of course, is Verdence Capital's Megan Horderman. Thank you. Meanwhile, let's take another check on these markets. Less than 20 minutes ago until the opening bell rings. You can see, again, quiet, this market trying to recover from that big downdraft that we saw yesterday. We are green, but of course, you can go ahead and call that unchanged. In any case, let's find some more action besides the small caps. Let's look under the hood right now with Abigail Doolittle.
Yes, well, beneath that relatively benign surface for the S&P 500 and the NASDAQ 100, we do have lots of outsized movers, including the shares of Cisco Systems, up nearly 2%. This is Citi has upgraded the shares to a buy on AI potential, plus a valuation gap to the other networking peers. Turning to United Airlines, this is an interesting one. So earlier, these shares had been down, now up about 1.4%. They put up a good quarter, but they have a similar commentary to Delta, saying that they think that there could be less travel around the election. It's not quite intuitive or logical to me as to why that would be the case, maybe internationally, but domestically, I'm not sure. But it is interesting. And then speaking of the election, after yesterday's rather robust interview with Donald Trump here on Bloomberg Television, we do have the shares of Trump Media and Technology up 5.9% over the last 15 days, or roughly 3 weeks, Sonali. This stock up more than 100%. One way for the market to say that they do think that the former president may have better odds of winning in November, but it's not over till it's over, so we've still got some time to get there.
Certainly the Trump trades throughout the week. Very interesting to keep an eye on. Abigail, we thank you so very much. Now coming up, Republican challenger Donald Trump defends his economic policy. We're going to play you part of his conversation with our editor-in-chief next. And in the next hour, catch my interview with Morgan Stanley CEO Ted Pick, taking his victory lap on the earnings today. Plus, later today, exclusive interview, of course, with billionaire investor Stanley Druckenmiller at 12 p.m. Eastern. It's a rare conversation. We'll see what's on his mind. Stick with us. This is Bloomberg.
Former President Donald Trump loves the word tariff and thinks Fed Chair Jerome Powell has the easiest job in Washington. He sat down with Bloomberg editor-in-chief John Micklethwaite at the Economic Club of Chicago.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before. And we're going to protect them when they come in, because we're not going to have somebody undercut them.
That was Donald Trump speaking with Bloomberg's editor-in-chief, John Micklethwaite. Joining us now is Kayleigh Lyons, co-anchor of Balance of Power in Washington. Let's talk about the reaction to the speech. Obviously, you saw him in a room at the Economic Club of Chicago, similar to how he addressed the Economic Club of New York really a number of weeks ago. How did the crowd receive him? And was the crowd really slanted towards this kind of pro-business mindset that would have been otherwise afraid of a Democratic administration ahead and what it means?
Well, I think we heard a bit there of how the crowd largely was reacting to him, Sonali. It did seem to be a friendly crowd. There was a lot of applause, laughter in some instances when Trump threw laugh lines out there. And we do know that there was a substantial portion of Trump staffers and those affiliated with the former president and his campaign that were in the room. That said, of course, it is the Economic Club. These were business-minded individuals by and large, many of whom might like some of these ideas, including lower corporate taxes for companies that make goods in America and lower taxes across the board that Donald Trump is advocating for, even if economists do contend that that could be deficit additive and ultimately that his tariff policy could also fuel inflation. All that said, I was not in the room, so I can't speak to the exact composition and who exactly was clapping. I was just watching it alongside all of you here on Bloomberg TV. But I would just point out that typically if you're going to listen to someone speak, you might be more in favor of the kind of ideas they are putting forward, like when Matt Miller goes to a Fish concert. It's probably because he likes fish.
Fair point. Can't wait for the New Year's run at MSG. I was at the Economic Club of New York when Trump spoke there. I was also surprised by the support he had at the ECNY. Some of the most important people on Wall Street I saw there. Is he doing better maybe than we think, Donald Trump? I mean, he mentioned some of the early voting polls yesterday, and certainly in the betting markets, he's really turned it around.
Yeah, we have seen a change in the betting markets, and we've seen across polling from New York Times, Siena to other polls that things do seem to be tightening at this stage in the race with less than 3 weeks to go. I would point out that what we have seen in the last few weeks is also coming as we've had no real clear catalysts. When we look at Kamala Harris's candidacy, the person running against Donald Trump, she repeatedly had events that were helping to build her momentum. First, the fact that she became the presumptive nominee. Then she had the selection of her vice president, Tim Walz, then a convention, then, of course, the debate against Donald Trump, in which she predominantly was seen as winning. Since that debate, though, there hasn't been any other kind of event like that that has been able to continue to propel that momentum forward, which may be contributing to some of the tightening that we are seeing and why the candidates are now fanning themselves out across a number of mediums and a number of different networks to do more interviews like the one we saw Trump do with Bloomberg yesterday. Kamala Harris today is going to be on Fox with Bret Baier as she tries to reach out to more Republican voters who may not be in favor of Donald Trump.
Well, Kayleigh, we don't have much time left, but that's exactly where I want to go. The fact that Kamala Harris is sitting down with Fox News. You think about the criticisms that have been levied at Kamala Harris, that she hasn't made herself available enough to maybe not friendly media. What are we expecting to sort of hear tonight?
Well, she could face some tough questions on the issues on which she is weakest, the economy and the border. But we should also expect a more moderate version of Kamala Harris as she tries to attract some in the Republican Party onto her side. She has been attempting to create a sort of permission structure for Republicans to cast a vote for her rather than Donald Trump. We see that evidenced in her touting the endorsement of a number of Republicans, including former Congresswoman Liz Cheney, who has campaigned alongside her in Wisconsin just in the last few weeks. So that's really what it is about doing, is reaching across the the aisle, trying to bring more voters to her cause. And we're seeing her do that with other demographics as well, including black men, with an appearance on Charlemagne the God yesterday.
All right, Kaylee Lines, thank you so much. Of course, looking forward to that interview with Kamala Harris on Fox. Of course, just a little bit more than 24 hours after Bloomberg sat down with Donald Trump. This is Bloomberg. Well, the early release of ASML's earnings yesterday obviously sent a chill through the entire chip sector. And now we're getting, of course, the earnings call. So first of all, it kicked off with the CEO apologizing for the early earnings release. But when it comes to the actual details that spooked the markets, of course, remember, it was the third quarter bookings coming in at less than half of what analysts forecast that sent the stock to its worst day's performance in more than 20 years. When it comes to what we're getting on this call, so the CEO says chip industry growth drivers still intact. We heard from the CFO as well, saying that they see China for about 20% of total revenue next year, and that long-term trends are strong. So you take a look at what the stock is doing pre-market, of course, still down, not exactly getting a lot of comfort on this call.
You can see the live trade actually in Holland.
Yeah, so, if we pull that up, that would be good as well.
Their main listing, yeah.
Shares down about 3% right now after yesterday's wipeout, down about 16%. And of course, we saw what that did to the overall U.S. indexes as well.
Yeah, I thought it was interesting yesterday to hear that they said they're still in recovery mode. And you think about the AI chip demand, they can't even keep up with it. The problem is this is a bifurcated business, right? So if you're making chips for cars or industrial or PCs, it's just not as good. They said on the call that China will be 20% of their revenue. Last year, China was like 27% of their revenue. So they're ramping that down a little bit.
Absolute first question on the call. And you do see pairing of losses here. But again, that two-day chart was pretty brutal, wasn't it?
Yeah, absolutely. Of course, TSMC, which buys machines from ASML, reports later today. Going to be fascinating to follow that. But stick with us because we are less than 4 minutes away from the opening bell.
We are moments away from the start of trading on this Wednesday morning. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at futures. Absolutely unchanged on the S&P right now. NASDAQ futures not doing anything as well. We had a big drop in the chip stocks yesterday, and the positive bank earnings didn't really turn out to boost financials either. So not much going on in terms of the big indexes or the bell ringers. We have RXO. I guess they're celebrating an acquisition of Coyote Logistics. Here, apparently, the Food Network is ringing the bell because there's a wine and food festival, which is going to be pretty delicious. But the market isn't doing a lot right now. In terms of the index, we're going to see no direction here. Katie, where do you think we're going to go at the end of the day?
Yeah, the wine and food festival, surprisingly, not injecting much life into these markets. It feels like we've seen a lot of quiet opens over the past couple weeks and then a lot of fireworks by the close. So we'll see right now. But at least the arrows are green. Of course, we had that wipeout yesterday. You have these stock markets trying to regain that rally momentum, a little bit higher when it comes to both of these indexes. But the small caps, that was your outperformer yesterday as well. Still a down day, but less so. And then you take a look to the upside on this morning. You can see the Russell 2000 leading the charge, currently higher by about 0.8%. Meanwhile, you'll find a little bit more action if you take a look at Morgan Stanley right now. Sales and trading revenue beat estimates in the third quarter as assets under management topped $7.5 trillion. That's good for about a 4% gain as the markets open. We also want to keep an eye on Novavax. That's after the company said that the FDA has placed a clinical hold on its application for a COVID-flu combination and a standalone flu vaccine candidate as well. You can see shares a little bit of a wipeout of their own, currently off by almost 20%, Matt.
Wait, so can we not, because I don't want to get a flu shot and a COVID shot. Is there not like a single, can we not?
I believe that's what Novavax would like to give you, but having some issues getting that off the ground.
All right, let's, speaking of issues, let's take a look at shares of Intel. They are lower after Bloomberg sources said Qualcomm is going to wait until after the election to decide on a potential bid for the chip maker. Obviously, that's after earnings as well. Intel reports on Halloween night, I believe, after the bell. We're going to take a closer look at the chip sector with Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, let's kick it off with Intel, as you were just taking a look at, along with Qualcomm. And there has been some hope for this beleaguered chip maker. Once the gold standard, and then more recently, less exposure to AI and the U.S. manufacturing and other problems with some of their fab plans. In any case, down more than 60% on the year, so it's been buoyed recently, boosted, I should say, by the possibility of a takeover for Qualcomm. But as you just mentioned, Qualcomm is saying that there's uncertainty around the election. They want to see who's in the White House. Now, Palo has also said that they might help out Intel make a multi-billion-dollar bid. But today, investors looking past that. Yesterday's bad news has bled into today relative to the chip sector. And we're actually going to see over the last 5 days that the stocks overall down 2.9%. ASML holding down 16.4% over the last week. Yesterday, it was the worst week, I think, or worst day in 26 years. The company's been around for 28 years, basically pre-announced to the downside around sales. Today, the CEO coming out apologizing for the early earnings release and then saying that he thinks that the chip industry growth drivers are still intact. But it seems that the chips don't entirely believe it. And if we take a look at a chart of the stocks, the technicals, here we are going to see a pretty nice uptrend coming out of the October lows. And then over the last, basically this entire year, we've been in this massive range here for the shares, or excuse me, for the stocks. You can see this movement up. It looks like, Katie, that near-term uptrend is starting to break. If that happens, we could go right back down toward this level of support. A range is never interesting for the range. It's interesting for the way it breaks. That's a bearish range potentially. So let's keep an eye on the stocks and the chips. And, of course, those beautiful tariffs you were talking about, if that happens back in if the former president is elected, that could create further issues for the chips. That had been the poster boy for tariffs back before 2020.
All right, Abigail, thanks very much. Abigail Doolittle talking us through chip stocks. I actually took a deep dive into ASML.
Did you?
Yes, because I was thinking, what does ASML stand for?
Tell me.
It's Advanced Semiconductor Materials Lithography. It was a Dutch company, obviously, we all know that, but merged with, or did a joint venture with Philips back in 1984. So it's actually older than its IPO. Philips spun it off then in 95 and actually owns almost none of the business now. But.
And for our viewers, Matt doesn't even have Wikipedia open right now. This is just straight. You actually did your research here and you remembered it. It is pretty interesting. We never think about what these letters actually stand for. IBM, for example, International Business Machines.
Right.
Amazing.
Or what these companies do, right? They don't make
I can
chips.
tell you what ASML does. It makes chip-making machines.
That's right.
And as we learned, NVIDIA is a chip designer. They're all very intricately linked together.
Because almost all the chips are made, I was reading through, I think, Hoover's history, and it said 90% of ASML's revenue comes from Asia. And I thought, wow, that's a lot. But of course, TSMC, right?
TSMC, which of course reports after the bell today. So this ASML story, it's not over, of course. It'll be interesting to see what that brings. But let's broaden out this conversation now. We'll do that with Anne Miletti. She is Allspring Global Head of Active Equity. And for all the talk of the broadening out in the rally that we've been discussing over the last several months, it was interesting that yesterday, of course, you had one bad report from ASML. It took down the entire sector, NVIDIA included. That took down the entire market. For better or worse, Anne, this is still a very concentrated market.
It is a very concentrated market. And look, we got there because the growth rates, both revenue and earnings growth rates, were better in technology than anywhere else in the market. That's what took us there. I think the fear is that we will start to see some deceleration of growth. We'll still get that growth, but it's going to be lower, likely going forward. The law of large numbers plays against technology at a certain point, or for at least some of the companies. And then there's some other challenges as well. And so it's forcing investors to look elsewhere, and elsewhere where fundamentals seem to be improving, and you have that earnings momentum starting to shift on the upward trajectory, areas like healthcare, financials, utilities.
Well, Anne, you're head of active equity here. I'm curious how you invest around or with that big importance that tech has in this market. I mean, how are you treating it at this point, and how are you building a portfolio around it?
It's really interesting. It's a great question because as I talk to our portfolio managers across the board, they're believers that we're in a new innovation cycle that's going to be very long lasting. But it's not going to be as concentrated as the market is kind of pricing in today. You talked about chips a little bit earlier. Certainly, they have gotten huge multiples. We've also kind of forgotten in the short period of time that semiconductors tend to be cyclical. But that growth across innovation will extend beyond technology. It will certainly extend into software and other places in technology. We've just not seen that happen that much yet. And so our investment teams are thinking about where AI and where automation, where those things actually start to benefit the broader market, and looking for opportunities that are better priced, as well as, still not ignoring technology. It is clearly important.
So where are you finding? Where does AI benefit the broader market most?
It's interesting, Matt, because, healthcare is one area that definitely could use innovation, efficiency, and improvement. And AI could have huge benefits. Obviously, there's a lot of software that's used within healthcare, but med tech is a big part of healthcare as well. And I think we will start to see more benefits. Then you still have just the bottom or the basics starting to improve post-COVID, where you had lower utilization during COVID. We're starting to see some of that utilization improve, and some of the trends in healthcare services improve as well. So you kind of have the basics improving, but then you also still have the dream of innovation really helping change the healthcare system. So I would say that's one area.
It sounds so bullish, Ann, and we've been talking about the fact that this is the first week of the third year of the bull market, right? Saturday was the 2-year anniversary of the low on the S&P in 2022. And typically, bull markets last 3 years. I think 80% of the time, 2-year bull markets turn into 3-year bull markets. On the other hand, households hold more equities as a portion of their financial holdings than they ever have since the Fed started keeping records in 1952. And we're trading at 22 times forward earnings. We've only seen that in, COVID and 1999. So what do you think? I mean, are you cautious here, or do you jump in with both feet?
Yeah, it's a great point, Matt. And I think, I was talking to a few of our portfolio managers earlier this week, just a couple of days ago. And, the theme is we're not paid to take big bets here. We're not going to be heroes in this kind of market. But what we're experts at is really trying to find those underlying companies that haven't been appreciated by the market as much as the ones that are trading, kind of at that average 22 times or higher. And so that's kind of why we've been looking down cap a little bit more in the mid and small cap space outside of just large cap. It's why we've been more focused on broadening out the exposure beyond technology. So we're not trying to say anyone needs to make a hero's call and say equities has got another, gosh knows how much upside, but there's still an ability to make money in markets if you're invested in the right areas.
All right. Ann, thanks so much for joining us. Allspring Global Head of Active Equity, Ann Miletti, talking to us about these markets. And, they feel like they're getting a little bit frothy here, even after yesterday's drop.
It sounds like you've been talking to Cole Smead. I know he trotted out that household stat at the beginning of the week. I feel like that's one of those stats where I'm not sure why that's supposed to make me a little bit nervous here.
Well, because everybody has all their eggs in the same basket, right?
Yeah, but so it's a diversified basket, theoretically.
The problem is then if you get a downturn, like everybody's going to rush for the gate at the same time, right? And I've also been reading Nick Colas. The data trek notes are amazing.
Do you know why?
Why?
He went to Haverford. There's like 12 of us who went to Haverford.
He rides a Ducati as well.
That's pretty cool.
But Jessica,
he's got something for both of us.
Jessica Robb writes for Data Trek as well. She had some fascinating stats on NVIDIA. So I would think that small smaller companies are much more volatile than large companies. And she pointed out that 10 years ago, NVIDIA was only worth $10 billion. Now it's worth $3.4 trillion. And yet, the volatility of NVIDIA relative to the S&P is twice as much as it was a decade ago.
Also, the felt volatility of NVIDIA. You think about, again, the sway in the benchmarks. Even if you have this microcap biotech sort of company that's, going crazy, you're not going to feel that necessarily if you're one of those households that's so heavily
But
in
you'll
equities.
feel it if it's the biggest company in the MSCI All World Index.
You certainly will.
Bigger than all but 2 countries.
Yeah, well, good thing. We're going to talk about chip stocks next.
Sweet. I'm down. Coming up, it's been a whirlwind week for chip stocks like ASML, which we all know everything about now. Its CEO holding an earnings call as we speak. We'll give you the details next. This is Bloomberg.
All right, let's turn back to semiconductors now. As we've been talking about, ASML yesterday reported early that weaker than expected sales, also raising concerns about the future of the sector. You saw that with the absolute wipeout we saw this hour. ASML, its CEO, said that AI, it continues to drive results, but other departments are recovering more slowly than expected. And then also in chip news, you had Qualcomm reporting showing that it will likely wait until after the election to decide whether or not to buy Intel. That is according to Bloomberg sources. Let's discuss all of it with Bloomberg Intelligence senior analyst Mandeep Singh. And Mandeep, Matt and I were just having a robust discussion about what these different types of chip companies actually do. And I feel like the public at large is learning that chip maker is a really unnuanced sort of phrase. So talk to us about ASML and how connected all these other companies are to it, such that we saw the wipeout that we did yesterday.
I mean, when everyone talks about TSMC and how dependent NVIDIA is on TSMC, well, guess what? TSMC is dependent on ASML to provide the machines for manufacturing.
It's a daisy chain.
It is. And look, I think in this case, the cutback in guidance was clearly demand related. The 2 factors were, one, Intel we know is not doing well. It is looking at its CapEx plans. They're probably paring back on their CapEx, the foundry expansion. Some of that is getting pushed out. And the other one is China related. We've been talking about, how China sales would impact NVIDIA and everyone in the semiconductor space. It did impact ASML. I mean, it was 30% in 2023. Next year, it's going to be probably 20%. So
it had been much lower than 20% in the preceding years. I just looked on the FA screen, and they were putting up like 11, 14, 16% in 19, 20, and 21.
Yeah, so clearly there was a pull forward because in China, I think there were customers who ordered in anticipation of the restrictions. But going forward, you will have more normalized China exposure, and there are more restrictions. So look, in the end, it comes down to how much these companies are investing in expanding supply. We know TSMC has more demand than they can, supply with the chips that they're making, especially at the leading node level. But other ones like Samsung, Intel, they haven't caught up to TSMC when it comes to the leading nodes, the 3 nanometer,
By the way,
the 4
can I just ask about TSMC?
Yeah.
Aren't we getting those operations out of there? I mean, that's a pretty dangerous place to have most of the world's chip-making capacity, considering the heat with China, right?
Well, given the pullback in CapEx around spending on ASML machines, I guess it's not happening anytime soon. There is your answer. So, look, I still think it will happen over time, but near term, ASML's guide suggests 2025 will be more moderate than what everyone expected, and their estimates are going down.
Well, perhaps this brings us neatly to talking about Intel, because we know that U.S. government would certainly like to bring chip manufacturing back to the U.S. Intel is a big part of that, of course, has received billions of dollars from the CHIPS Act. In dire straits, Qualcomm, of course, Bloomberg reporting that Qualcomm, of course, may be going to wait until after the U.S. election and the inauguration to go forward with a potential bid there.
Yeah, look, there is a history with semi companies trying to buy each other. Broadcom wanted to buy Qualcomm. That never went through. Qualcomm wanted to buy NXP. That didn't go through. So a transaction of this size, which I expect would be at least, $150 billion if Qualcomm was to make a complete bid for Intel. you're not going to have regulatory approvals like this, and you want some certainty because there is a breakup fee element to it. And I think I'm not surprised they want to wait until November, at least to have some.
My prediction: they're going to wait forever. That's never going to happen.
Really?
Yeah.
No way.
What do you think?
Why? It's totally different business,
maybe
right?
Maybe parts of the business of Intel do make sense when it comes to Qualcomm looking to get into PCs. Not everything. I think nobody wants to get into the foundry side given how much investment you need to make. So clearly pieces of that do make sense for Qualcomm.
I think a lot of people who are, investors in Intel would really like it to happen. So
for sure.
We'll see,
At a high valuation.
Yeah, what a rough ride, of course, for Intel, down another couple % right now. Mandeep Singh from Bloomberg Intelligence, thank you so much. You can follow the ASML call by typing TLive Go on your Bloomberg terminals. Now, coming up, we'll head to Mexico City, where Bloomberg CityLab is in full swing. That's up next. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. Take a look at stocks right now because we've turned decidedly for the S&P 500 down about 0.1%. But look at the NASDAQ 100 right now. Your big tech names currently lower. Of course, we know that it's been a rough ride for the chip sector. You have NVIDIA higher right now, but you have the likes of Apple, Microsoft, Qualcomm, Intel, etc. down right now. That is weighing on your big tech index. And once again, the small caps outperforming the benefits of a diversified portfolio. You have the Russell 2000 currently higher by about 0.8%, Matt. We'll see if it holds.
All right. It is day 2 of Bloomberg's CityLab Summit in Mexico City. Over 500 mayors and policymakers are gathering to discuss urban innovation, affordable housing, and probably most especially migration. Bloomberg's Carlos Rodriguez joins us now on the ground. Carlos, great to have you on the program. What are the most pressing issues? Yesterday, we spoke with Ron Nirenberg, the mayor of San Antonio, and for him, obviously, immigration is front and center. I imagine that's the case for a lot of U.S. mayors.
That's true. It's especially important for the mayors closer to the border, right? But it's also fascinating to hear how some of these problems are shared even in other nations. We hear it from mayors from South America, from Europe, where they are also facing this type of problems, not only in immigration, but also some historic challenges like irregular settlements, lack of efficient transportation. And also, they're discussing new problems that are arising with the advance of technology. For example, I know a few days ago in your program, you were discussing how Elon Musk is going to deliver on robot taxis. How are they going to shape the new downtowns of cities? Well, now the mayors are the other part of the equation, and they are also exchanging ideas on how to address this new reality of autonomous driving, of social networks. They have some concerns that there's so much mistrust in the governments, in the regulations. They are trying to get up to date in the digital age and address some of these concerns with better technology and more transparency.
And Carlos, we have just about a minute with you, and I'm curious to talk about housing. What is being discussed when it comes to housing, and what hurdles are these mayors facing when it comes to actually putting those ideas into action?
Yeah, the mayor of San Antonio discussed some of these so-called transit development hubs, where they are pushing to have the hubs of transit in the same place of new developments of housings and make space for affordable housing. And those ideas sound great. The problem is that they're facing in some of these cities, and we see it in many American cities, is that people say they're great as long as it's not in my backyard. So what they need to do is to have better communication with the local communities, and they're trying to do so. Also, we heard a little bit of the experts, the city planners, and their solution for many of these is stop worrying about some of the consequences or the byproducts of these developments. Start worrying about resistance from the community, and you should only be obsessed about creating a higher supply of housing.
Carlos, great having you on the program. Thanks so much for joining us. Bloomberg Carlos Rodriguez there at the Bloomberg CityLab Summit in Mexico City. Coming up in the next hour, we're going to talk to the CEO of Morgan Stanley. Ted Pick joins us live at 10:30 for an interview you don't want to miss. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld, Sonali Basak on assignment. And coming up, beats across the board for Morgan Stanley in the third quarter. We'll have an interview with CEO Ted Pick later this hour. Is a reckoning coming for regional banks? We'll discuss the state of play in commercial real estate with Rabil, Kayne Anderson's CEO, and a new deal that will let you hold money in U.S. Treasury bills instead of cash. We'll discuss with David Dindi. He is the CEO and co-founder of Atomic. But first, let's get a check on these markets because we are moving lower right now, Matt Miller. The S&P 500 currently off by about 0.1% because all of the action right now is in big tech. Once again, off to the tune of about 0.6%.
Yeah, that's right. We're looking at drops on the tech stocks today. I will note that the Russell 2000, which you follow so closely,
glad you're bringing that up,
is sitting in a rally, right? Up almost 1%, which I think is interesting, especially as the Russell 1000 is down, the Russell 3000 is unchanged. There's something about the middle of the pack there that investors like today.
Yeah, big time. The rotation trade coming back, and you can see that in the intraday action and the bond market. The 10-year Treasury yield currently down about 3 basis points.
Can I just also say that David Dindi is coming on from Atomic Invest. They've made a deal with NerdWallet to allow retail investors to buy fractional treasuries online, which I think is really fascinating. It's a market that's typically pretty opaque for retail investors.
No, you're right. I am curious, what the appeal is over a money market fund, for example, but I know we'll get into all of that. But for right now, let's stick with real estate. We have a great guest sitting to my left. We're going to be talking about commercial real estate, which has over $1 trillion due in the next 2 years. It's a big question mark, of course, heading into regional bank earnings, who are more heavily exposed. So let's discuss the state of play right now with Rabil. He is the CEO of Kayne Anderson, which, of course, is an investment management firm focused on real estate. Al, it's great to see you in person.
Great to see you, Katie and Matt.
So I know that you don't necessarily play in the office space, but you can't have a conversation about commercial real estate without talking about offices, especially in the likes of New York City, for example. There's still a lot of doom and gloom. What's your current feeling when it comes to office?
Current take on office is you have a tale of two markets. Class A, very strong in many areas, including New York City. Class B and below, really, not there, and in my view, probably not coming back for a long period of time.
Well, could you just quickly talk about what is Class A, what is Class B for the layman listening?
Class A, highly amenitized, very well located. So, sort of think, walk in, marble countertops, beautiful fit out. Class B, sort of your Broadway corridor, if you're talking New York City, sort of garment district, lesser fit out, older buildings. And I'd say that gravitation to Class A, we've seen that in many markets, and actually you have pockets of strength there. But broadly speaking, I think the office market has changed forever. And people are like, when is it coming back, or is it coming back? I think there's a new normal, and I don't think that the pandemic dynamics are really going to change. Meaning, we are going to have a hybrid situation for a long period of time.
By the way, that makes me wonder how the entire commercial real estate landscape is going to change. And we're going to get in a moment to what you own, which is, I think, probably the safest part of commercial real estate. But in terms of the office landscape changing permanently, a new normal, people staying in the suburbs, but also shopping, eating in the suburbs, maybe working in the suburbs, at an office, not just at home, right? Doesn't that change everything?
I'd say yes, in a way that definitely changes everything. I will say that, and you were going there, the reality is, we've never invested in office because it's highly correlated to the macro economy. And the reality is, yes, the pandemic shifted office. We invest in seniors housing as an example, which obviously was negatively impacted by the pandemic. Nevertheless, the underlying demand dynamics never changed. So what you have is, a doubling of 65 and older people between 2010 and 2040 in the U.S., 40 million to 81 million, almost a tripling of 80 and over population. So we've always looked at inelastic demand asset classes, and I think a big difference between office and seniors housing, as an example, is that Office, highly correlated to the macroeconomy. Now the pandemic, massive shift, hybrid. Seniors housing, negatively impacted by the pandemic. Nevertheless, you've seen a recovery, and looking in the windshield rather than the rearview mirror, you have inelastic demand, really escalating demand for the next 20 years.
Right.
At the same time that you have actually dramatically reduced supply, and that's true for medical office, that's true for student housing. Actually, it's true for all real estate asset classes. The difference between those that have inelastic demand or escalating demand is that you've got escalating demand met with lower supply. So you've got this demand supply imbalance that exists today and is only going to become more exacerbated going forward.
That's fascinating. So to oversimplify, it sounds like you would rather have exposure to demographic risk, if you want to call it that, rather than macro risk.
Listen, I think demographics impacts all investment decisions, not just real estate. So those demographic tailwinds and the massively aging U.S. population, 90% of healthcare costs are spent after age 65. So the statistics are irrefutable. We look for asset classes that, despite, I'd say in the case of seniors housing, the pandemic was a pothole, not a sinkhole. For office, maybe a sinkhole, at least certain parts of it. But the reality is that those demographic tailwinds are not just here today, tomorrow, 3 years from now, 5 years from now. They're here for the next 20 years. And so we want to tie into that. And I think you've got a unique opportunity today in terms of where the market sits. And we can talk about that. But obviously, you had rapid interest rate increases. You've got motivated sellers. You've got a reduction in supply because of, as you mentioned, $1 trillion of real estate debt coming due over the next 18 months, plus or minus. So. Right. You've got a lot of factors that if you're looking forward and you have the fortitude to sort of put the past behind you and say, what does it look like going forward? I think the alternative asset classes, which are all the rage today, and not just the ones we invest in, but we're in medical office, seniors housing, student housing, but there are obviously other sectors, data centers, et cetera, right, that also have demand characteristics that are similar.
I guess you could see this as an entry point, right? Because rates went up so far, so fast. You had an entry point during COVID as well. That's what the pothole says to me in terms of seniors. The difference between student, which you're in, medical office, which you're in, and seniors is that you got to staff the latter, right? And it's very difficult to staff, especially like on the top end, senior housing. How do you deal with that problem?
So we invest in the higher/highest end of seniors housing. So, the average net worth of our tenants is somewhere between 3 and 5 times the average U.S. net worth, and the average age is 84. So simply put, we're dealing with people who have more money than actuarial years left. And so what they're looking for is a high quality lifestyle. I'm not going to say they're not impacted by increasing, but that portion of the seniors housing segment is able to pass through cost dynamics in a better way and more efficiently than, say, middle income or lower middle income.
So the staffing issues are more in the middle and lower.
Correct.
I get it.
That is correct. Absolutely. I'm sorry, go ahead, Katie.
No, you go on.
No, I was just going to say, seniors, you're correct, though. Seniors housing, you can look at it as real estate with a business attached or a business with real estate attached. I mean, it is clearly an operationally intensive asset class, which is the good news and the bad news, because it is a barrier to entry for many in terms of it's not simply a real estate investment in terms of collecting the rent. Right. You have to have the operational capabilities.
So we've talked through the fundamentals. I'm curious about how you're investing, whether you're playing more heavily in debt or in equity right now, and how that opportunity set has changed.
So we're both. And I say, to me, it's not an either or, it's an and. I think that you've got the best investment opportunity that we've seen since post-GFC, so the last 15 years, and that's both debt and equity. On the debt side, I think that and talking about banks, and you've seen, obviously strong earnings reports recently. Nevertheless, you have a lot of unrealized losses sitting on bank balance sheets, and I'm not talking about the JPMs of the world, but we've got 4,500 banks or 4,600 banks in this country. We had 7,500 in 08. I think we're probably going down to 3,000 in the next 5 years. So the narrative in terms of we're out of the woods, soft landing, everything's great, I can see a path there. But I've been in the hard landing camp for a while. I'm gonna back off of that a little bit.
A little bit.
A little bit. I would say that what I think is underestimated is the potential for a significant downturn. So I'm not predicting that. I'm just saying that I think most investors are painting a too rosy picture in terms of how quickly rate cuts are going to come and also underestimating geopolitical
well, or
risks.
maybe we just see a multifaceted economy the same way you do in commercial real estate, right? I mean, some areas are going to do well, some are going to be doing poorly.
Ed Yardeni.
Oh, I think that's absolutely true. And the pandemic point, I won't say it created winners and losers, but it definitely.
Al, I want to get into a question on data centers because you mentioned, and it's so hot right now. Is there a specific location that you like? Does it have to be near power? I mean, how do you suss out the best data center investments?
So we're not a data center investor for a number of different reasons. One is that the real estate is not the priority. It's actually getting energy to the data center. And so, and it is obviously, that space is occupied by a lot of well-capitalized players. The other dynamic is that we can't assess the technology dynamic on a going forward basis. So I can't tell you 10 years from now, yes, we can say there's more data, there's escalating demand. But obviously, what went into 30 warehouses 20 years ago goes in your iPhone today. I don't know where that's going forward. So difficult for us to make that assessment. I will say, I don't think that landscape is going away, and there's certainly an opportunity for some out there.
Really fascinating stuff. You never fail to provide us with awesome intel. Al, thanks so much for coming in. Al Rabil there is the CEO of Kayne Anderson. Coming up, Atomic and NerdWallet are partnering up to change the way consumers can hold their funds, can access treasuries. It's a market that a lot of them haven't been invested in directly in the past. They will be able to now. We'll talk about that with the Atomic CEO, David Dindi, next. This is Bloomberg. Let's get to high interest now. Look at what's making headlines around the world. Public and private markets are converging, according to Apollo CEO Mark Rowan. Speaking at an alternative investment summit, Rowan said private markets were attracting more competition for trading on Wall Street. Here's what he had to say about the industry's limitations.
I think we as an industry will be limited by our capacity to find good investments rather than in the long term, not in the short term, our capacity to raise money.
Ken Griffin has found a buyer for one of his luxury properties in Chicago, but at a loss. The Citadel founder's penthouse went under contract for an undisclosed amount, according to Zillow, but it was listed for $11 million in July, and Griffin bought the property for roughly $21 million in 2017, according to Cook County records. He never lived in the 38th floor residence, and it was marketed as unfinished. NFL owners finally voted to approve the sale of a 10% stake in the Las Vegas Raiders to Tom Brady and Knighthead Capital co-founder Tom Wagner. The deal was stalled for months over valuation concerns. Both Brady and Wagner upped their offers. The former quarterback is expected to have a role in the team in decision-making. I'd say that's a given, right?
I would assume so.
Probably the most successful quarterback of all time. In terms of success, I note that Morgan Stanley shares are up now, I think 8% and change, which I think is fascinating, Katie, because they didn't really have a blowout quarter. They had, I think, trading revenue was up 13%. Goldman Sachs was 18%. JP Morgan was more like 25%. They had profit up 35%. Goldman Sachs was up 45%. By the way, Goldman yesterday was unchanged at the end of the day.
That's what I was going to say to you, because we'll see how resilient these gains are. Because remember, about 24 hours ago, we were talking about this big gain in Goldman Sachs. By the end of the day, that big gain had entirely erased. Now Goldman's seeing a little bit more love, but these have been very hot and cold markets. You've been seeing that at the individual stock level, at the index level as well. So it's hard to say.
Yeah, and now we're looking at solid gains on the index level. The S&P up 0.1%. It had been down briefly, and the Dow adding 140 points. That's the Dow Jones Industrial Average.
You know, I've heard about that, but it's like a distant memory. I don't really think about it.
It's for old people.
Right.
All right. For young people, Atomic and NerdWallet are introducing a new type of cash account that allows individuals to hold their funds in U.S. Treasury bills instead of traditional cash. Now, you could have done that already, but you would have had to plunk down $10,000 per bond, or 10. And now you can buy fractional treasuries. That, to me, is fascinating. Joining us now is the CEO of Atomic, David Dindi. This is the kind of disruptive technology that you've introduced. I have always thought, how am I supposed to buy bonds, you've got to put down so much money just to get in, and now I could invest a much smaller amount. How have you done it?
Well, you know, the challenge that NerdWallet and Atomic sought out to solve is how can we make treasury bills behave and feel like cash? And when you think about treasury bills today, they're much less flexible than cash in the sense, as you mentioned, you have to buy them in secondary markets in increments of $1,000. We built technology to fractionalize ownership of treasury bills so you can actually purchase it in increments of 1 cent, which means that if you put it into account, you can actually deposit and spend as well in increments of 1 cent.
Right. Well, explain to me, David, how this isn't a problem necessarily solved by money market funds, because I'm sure a lot of people watching could say, okay, can I get treasury bills already in a money market fund? Can I just click onto Fidelity or my brokerage platform and sort of do this already?
Money market funds were a simplification of access to treasury bills, but you have to consider the fact that with money market funds, you have an expense ratio, so you're not getting the highest yield you can potentially get. And at the same time, you might not be realizing the benefits of being exempt from states and local taxes as well that you do get with treasury bills.
So I could buy, for example, a 30-year. It's yielding 4.3% right now, and I could still use the account to pay my bills. I wouldn't have to move money around first. I can essentially just use it as a checking account.
You could. We've simplified the whole process of owning a treasury bill. Also, the whole ongoing management of having a treasury bill. The fact that they have fixed duration and you need to reinvest it every time one matures. All of that is abstracted away so that you can use the account like a cash account without having to be a financial expert. Now, we wouldn't necessarily be investing in 30-year
No, you have
treasury
massive
bills.
price risk, obviously.
Exactly.
Yeah.
We'd keep it to 4-week treasury bills in that regard.
And let's talk a little bit about timing here, because we've been talking about how, you know, if you take a look at money market funds, assets at an all-time high, but we speak to investors all day long who say now is the time to get out of cash. You have the Fed cutting rates. Are you concerned that demand might not be what it had been if you had launched this, say, a year or 18 months ago?
So I think there are two schools of thought. And when you look at the data, when you look at the past 6 rate cuts, and when you look at what the asset levels in retail money market funds were, you'd actually see that when the rate cut cycle began, assets in money market funds continue to grow. It's only once rates dropped below 2% or below 1% that you started to see outflows. So we don't expect there to be outflows anytime soon. And at the same time, we're not necessarily providing this product to people who are looking for an alternative to park their cash instead of investing. Instead, the product is for people that are looking to save for short-term goals like a wedding or a down payment, people for whom wealth preservation is a key tenet of why they're putting money in this account.
Is there exclusivity to this agreement? I mean, you build this technology and then NerdWallet uses it on their website, right? I'm sure other websites are going to want to be able to offer the same. Do you then have other clients that will use it, or have you signed up to NerdWallet for a certain amount of time?
Well, if you think about what Atomic does, Atomic works in the background with fintech apps, with banks, and with credit unions to make investing available for them. So it's in our business model to partner with different companies and to make different products available. Now, the reason why this partnership with NerdWallet is exciting, it's not exclusive, but it's very exciting, is because NerdWallet reaches tens of millions of Americans every month. They help them make informed decisions on what to do with their finances. And so they are in a unique position to really making this treasury account mainstream, just given their reach and given the trust that they have with their members.
What does this mean then for your business? I mean, I imagine it's a feather in your cap in terms of fundraising if you wanted to do another round.
Well, it's an exciting time for us, and we have multiple partnerships like this that are also coming to market soon. And so very excited to see what happens next.
All right, David, really exciting. Glad you could make some time for us. Of course, an exciting day for you. That is David Dindi. He is the CEO of Atomic. Now, coming up, can your Apple Watch predict when you're going to be sick? Users are convinced of it. Social climbers up next. This is Bloomberg. All right, it's time now for Social Climbers. Companies making waves this morning, and first up, Interactive Brokers is falling after the brokerage firm's third quarter results missed estimates. One KBW analyst says that the weakness is thanks mostly to lower securities lending activities. Shares currently off by about 3.2%. Next up, we have the oncology company Novocure. It said today that the FDA has approved its treatment for lung cancer in adults. Wall Street weighing in on the news, calling it an important milestone and a big win for the company. That's good for about a 5% rise. You also have some Apple Watch users reporting that the Vitals app that's available on the Series 8 models and above is able to predict illnesses like COVID or the flu days before symptoms arise. The app, of course, tracks your temperature, your heart rate, and your sleep data, a number of other data points. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, we take a look at markets right now, and you can see that it's pretty quiet. The NASDAQ 100, a big reversal. Of course, we were looking at losses of about 0.5%, but some movement underneath the surface right now, and that's good for about unchanged on the NASDAQ 100. A little bit better if you take a look at the S&P 500, currently up about 0.2%. We know that Morgan Stanley is having a great day. We know that United is having a great day as well. That's helping to lift the index right now. And then you take a look at the bond market, and Matt, it's interesting. Of course, you still have yields a little bit lower right now. We are just about even at 4% on the 10-year yield. That has been sort of the epicenter of volatility, I would say, Matt.
Also, no surprise that NVIDIA being up more than 2% is adding the most points to the S&P 500, almost 9 points. I'm still interested in how much your heart weighs, Katie. What is your heart weight?
I mean, I'm not exactly, a whale, so hopefully it doesn't weigh very much, but who knows? Apparently your Apple Watch can track that. That's a joke, of course. I said the word wrong. Anyway, coming up, Morgan Stanley shares jumping, as we're saying, after posting beats across the board in the third quarter. We'll speak to Ted Pick, the company's CEO, joining next. This is Bloomberg.
I'm Sonali Basak, and you're watching Bloomberg Open Interest, and I'm standing by here at Morgan Stanley's headquarters in Times Square alongside Morgan Stanley CEO Ted Pick. Of course, you had your third quarter earnings report today. You're watching your stock soar. You're having one of your best days ever, really. If it holds, it'll be at least your best intraday in 4 years, and certainly your best day since you became CEO. What do you think is the biggest contributor to Morgan Stanley's performance at this point in time?
Well, first of all, Sonali, welcome to Morgan Stanley. Thank you for wearing Morgan Stanley blue. We're thrilled to have you here. I think the story of our earnings is one of consistency. Consistency on the top line, this quarter, 15 billion plus, and now all 3 quarters, 15 billion plus. And we've seen balance in the 2 major segments of wealth management and institutional securities, where the profitability is roughly equal. We've got great performance in the third segment, investment management too. And then importantly, if you think about our sequential EPS, 202 in the first quarter, 182 in the second quarter, 188 in the third quarter. So I think it's a consistency story more than anything. I'd say the second thing is operating leverage. As you know, we reduced our operating leverage needs by about 300 basis points improvement, such that when you see our returns on tangible, they were 17.5% for the quarter, 18% for the year to date. So it's an operating leverage story too. And then, of course, we're talking about growth. We're talking about growth in wealth and investment management and in the investment bank, not just off this quarter, but in the years to come.
It's interesting because, of course, in wealth, you're already really the largest, of course. But when it comes to investment banking, I remember a year ago, what you told me was that equities, fixed income, and across investment banking, you're focused on being number one. Now, notwithstanding today's report, you still have a ways to go with the other 2 investment banks when it comes to revenue. How are you closing that gap?
I think that's a great question in the sense that we want to generate real returns and be in front of clients in the investment bank, and you see the share gains. You see that we've done $3 billion in equities for the last couple quarters. By the way, we did that $3 billion with lower VAR. So the $3 billion versus last year's number in the mid-2s in equities was done with roughly the same VAR. So there's an element of the composition of that revenue base is about getting closer to clients. You could feel those metrics. And I think the fact that we were able to navigate what happened in Tokyo, what happened more recently in China without a ton of volatility in the books, able to monetize that with clients in prime brokerage and cash equities and derivatives is important. And then if you look at our fixed income business, it's been stable, really a stable business which has underlying volatility, just it's part of what foreign exchange and rates and credit are. But they've been stable, and I feel like in both those businesses, there's an element of the leaders pulling away from the pack, just because it costs a lot to run those businesses every year. If you're going to be connected with the clients, you need to be connected across the entire product suite. But also, Sonali, as you know, you have to be connected around the world. And so we've been spending time in Tokyo. We've been spending time on the continent. We've been spending time in India, making sure that we are connected with clients. And, of course, in Hong Kong, we had an important quarter. So I feel good about the global business. I feel that we now can really lay claim to being one of several global investment banks. You tell me how many you think, but that business can generate real operating leverage. And when the cycle demands it, like it is now, where things are beginning to happen, that we can lean in.
You know, it's interesting, value at risk, for those of you at home, that is what VAR is. And it's interesting, you were watching markets near record highs, 46 record highs this year already. You're watching hedge funds with record amounts of leverage. Do you worry at all about where we stand today, given what it's taken to get here?
Well, we certainly are always paying attention to where there's leverage in the system, because we lend and we are market participants. So we're keeping an eye on all of our counterparties, our clients, constantly looking at terms of trade, where we are in the capital structure. I do think leverage, though, has some distinction within the asset classes. So, for example, our prime brokerage business is at highs, and some of the traditional long-short investors, as you say, are operating it on a fully invested basis in many cases. But if you look at other segments like the multi-strats or the quants, they're actually operating at leverage that is roughly close to the long-term average. So there is leverage capacity, but I do take your point that it is very important for us to continue to pay attention to where there may be leverage in the system. Now, leverage is more expensive given we have higher rates, and the reality is we're all looking to do the right combination of high-margin business with clients, which means that you have to be thinking about clients durably over decades. Which clients are going to be in the businesses you care? Where might we be working with a client across our firm to manage those assets, source assets, structure, finance? So it's not just the classic investment banking play. It's also their interaction with us in the wealth management context, their interaction with us in the investment management context. And you've heard Sonali and me talk about the integrated firm. That's where we think it's powerful, not just because there's interconnectivity, but there's also sort of an ongoing diligence around who we're interacting with, at what level, how do they think about their strategy and culture.
Now, I also want to move away from trading and over to M&A and IPOs, because this morning you told analysts that you are bullish. When do M&A, big deals, and IPOs in large form come back, and how large will they be when they do?
I think you hit on it. They're going to be larger. They're going to be larger because it is a process to go public under Starbucks, and for smaller companies that may be orphaned without the proper research, if they have a great growth story, why can't they go public? We're going to continue to be the underwriter to exciting young companies that only have a small number of years of operating experience and get through the entire 33 and 34 Act process of going public and grow, and then eventually either become acquiring vehicles or they themselves get bought out. That will continue. But what is more likely, as you know, and you spend a lot of time talking about, there is $1.3 trillion of dry powder held by financial sponsors. There is at least $3 trillion in the ground, 10,000 portfolio companies, and for the first time in almost 15 years, the rate of deployment is outpacing the rate of raising. So why is that important? As we both know, because that equation means those private equity sponsors need to monetize. How are they going to monetize? They could sell to other sponsors, they could try to find a deal with a strategic, or they could go public. So I think the beauty of going public as larger companies is coming back, but I also think it's going to be a global phenomenon. I think you see equitization rates really starting to increase in places like Japan that have been so quiet for the better part of 35 years, where we have a leading business. On the continent, places like Italy, you'll see it in the Middle East. So it's a global business, probably smaller unit size, but larger companies that need the full suite of our products.
You know, we hear over and over at Bloomberg that people are waiting till the election. They're waiting till the election. And a lot of investors are guiding to volatility headed around the elections. How are you preparing for that? And how are you hearing from clients on how choppy things can get?
We stay close to clients, as you would expect, because it's a coin flip on any of the red, blue, blue, red combinations. They're nimble and staying pretty liquid around what might happen. The reality, though, is not only do we not know what the combination is going to be, we don't know what the policy reaction function is actually going to be off of what has been said. And for that reason, I think you have a number of investors that are actually just sort of continuing to plow forward on the view that the economy is in pretty good shape, and that consumers and corporates are in great shape, so that when there is an election outcome, once there's a sense for whether new policy will actually get affected, then they can have a reaction, and obviously that also then brings into question what monetary policy will look like. I think that our job is just to stay close to clients and to make sure our infrastructure is fit for purpose. So we do run tabletops to make sure that not just that we can help offer solutions to clients, Sonali, but also that we have our act together internally. Even after the election, is there a sense of which party at this juncture is better for the stock market? Do you have a view? No, I don't. I really don't, because I don't know that we can imagine what the combinations will be, what the mandate will be, and what the policy action will actually be coming off of what's been said during the campaigns. What I do know is that the economy continues to be in pretty good shape, and that gives any new administration some tailwinds. But of course, they need to also continue to imagine where we are in the election cycle, and they also have to pay attention to deficits and national debt and all the things you've been talking about. You know, there's the election itself, the vote, and then there's the moment till the vote is certified. Do you expect uncertainty to clear up quickly, or do you think it will last for a while? I know what I'm hoping for is what we all hope for, which is that the election is a certain outcome, and then we just go about getting a sense for what policy is. If there's uncertainty, that could go on for a bit of time, but markets tend to be reasonably sanguine about that kind of uncertainty. For a number of days, there could be some jittery behavior, but assuming we know where we're going, the markets should align in due course. You know, another uncertainty is capital rules around the big banks. The U.S. is mulling revised capital rules with lower capital requirements than initially put forward. How do you feel about the direction of travel? I feel like the direction of travel has been constructive. We are carrying a capital buffer, as you know, about 160 basis points. We continue to carry that kind of buffer because it's an uncertainty that affects Morgan Stanley. And, you know, if I think about the three pillars of things that I care about, Sonali, at this place, I care about a strategy, which is to raise, manage, and allocate capital for individuals and institutions. I care about our culture, which is one of rigor and humility and partnership. And I care about financial strength, capital, and liquidity. So whatever the we'll call it vicissitudes of the discussion going into the election, I think it's probably the case that we're not going to have resolution on this until after the election. But I think the industry has made its case on where some real modifications should be made, and I think the regulator is largely listening, and we'll have to see how that plays out coming out of the election. Ted, do you think if Trump were to win the election that these capital rules are revised almost entirely? No way of knowing. No way of knowing, because I think, in fairness, there is a desire to put the puck on the ice, and it may be in everyone's interest, whatever the administrative combination, to get something done. And if the industry feels it's reasonable and it's reasonable for Main Street and for our client base, there will be an effort to go forth. On the other hand, if it continues to be a tough one, we're going to have to continue to talk. You know, one more question for you before I let you go. Today, I was joking, it's like the comeback of the Morgans. Your stock commands a higher price-to-book ratio than even J.P. Morgan's does today. Why do you think that is? Well, I think it's because we've got a durable business model, and we know we do. You know, we raise, manage, and allocate capital for clients, individuals, and institutions, and that puts us in two spaces that are secular growers, and they're global growers. the classic wealth management business with 15,000 financial advisors, our fantastic E-Trade platform, our growing workspace. Our investment management solution with its parametric tax customization product, part of a growing investment management space. As you know, that is a secular grower for alts. And then the investment bank, where there's a ton of growth.
Ted, we have to leave it there. Congrats on the report today. Of course, that is Ted Pick. He is the CEO of Morgan Stanley.
Thanks, Sonali.
All right, Sonali, thanks very much for that interview with Morgan Stanley CEO Ted Pick. Don't miss, by the way, speaking of Sonali knocking out of the park, her exclusive interview with billionaire investor Stanley Druckenmiller. That is coming up at 12 noon today. Definitely an interview you do not want to miss. I will be... Is it fair to say I'll stay at the office late to watch an interview at noon?
You'll be here until at least
I'll be here until at least 12:25 today. Up next, a story about the labor force shortage. North Dakota's workforce director, Ralston Howe, discusses how legal immigration can help fill the gap. This is Bloomberg.
All right, it's time for our daily Wall Street Week conversation. And with the majority of states across the country experiencing labor shortages, the question is where to find skilled workers. David Weston speaks with North Dakota's workforce director, Ralston Howe, about the state's initiative to recruit immigrants.
Well, right now in North Dakota, we believe that we have 30,000 open jobs. Now, that number comes from not only the jobs that are posted, but we know that a number of employers, especially in transportation or healthcare, might only post a job one time, but they need multiple workers to fill that role. Nurses are a great example. A hospital might only post one nursing position, but they're going to hire 50 if they can get them. And so when we look at all of the different nuances that go into our tracking system, we do believe that there are 30,000 open jobs in North Dakota. And although our workforce continues to grow, if we get every high school and college graduate, every individual coming out of our correction system, every person on disability into the workforce tomorrow, we would still have thousands of open jobs. And so we really do need to be looking outside of our state's borders and outside of our nation's borders to help identify how we can recruit workers to fill the jobs that we have available.
The legislature created this, so they must have wanted it. But is it controversial within the state? Because immigration has become a matter of some controversy other places in the United States.
With the political climate that we're in, immigration has become a really hot topic. And when we talk about the work that we're doing through the Office of Legal Immigration, a lot of times the conversation does go to conversations around the border or illegal immigration, and that's really not what we're doing. And so, of course, we have those conversations with stakeholders in the state, but really our focus is proactively identifying appropriate pathways and programs that we can utilize to help fill jobs in North Dakota. Employers have been responding really well. There's a ton of enthusiasm around the work that we're doing. Communities are responding well too. And so we've been able to really work with those who are already working in this space. We're working with national experts that can help us best utilize these pathways and create a resource available for employers and communities to better understand and navigate this really complex immigration system that we're working in.
Do you work with other states in similar efforts to try to attract legal immigrants?
So there are 19 other states that have similar offices. Many of them are called Office of New Americans, and most of them were created out of humanitarian need in response to an influx of individuals coming into their states. North Dakota is a little different. We haven't had that same type of challenge, and so we were proactive in creating our office.
And that was Ralston Howe speaking to David Weston. And of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. All right, let's get a check on these markets. A lot of intraday volatility. The S&P 500 now a little bit higher. It was a little bit lower. Now we're up to the tune about 0.1%. I was going to say 1% That would be something. You're seeing that volatility really emanate from big tech. Of course, there's been a lot of question marks over the chip sector in particular that is being reflected in the NASDAQ 100, hovering now about 0.2% lower, and then the bond market a little bit of a bid underway. But let's focus on those tech stocks. We're going to do that with Bloomberg's Bailey Lipschultz joining us at the desk. And Bailey, you were telling us a very interesting story. You were on 6 yesterday. That's the 6th floor of this building when that ASML headline crossed yesterday. Took you by surprise and the whole market as well.
Yeah, it was terrible, really. And Matt, like you were saying, I don't know that the company completely missed expectations on the booking number, or the Wall Street analysts were misreading expectations and guidance from the company, because normally
analysts estimated 5.4 billion euros in bookings. It came in at 2.6 billion.
That's bad.
This is something that, I mean, how do you misestimate by that margin?
And the stock's reacting, as you can see, 2 days down 20%. And this isn't a small company by any stretch of the imagination. Just looking on DES right now, still $276 billion, one of the biggest semiconductor companies in the world. We are obviously going to shift our focus now to Taiwan Semi, expected to report earnings tomorrow morning. I say expected because ASML accidentally reported their earnings, so who knows what's going to happen.
They said it was a technical error.
Yeah.
Is that a fat finger? Did somebody accidentally push publish?
If you could break that story, that'd be great.
That would be the fun one. It kind of reminds me, not really, but similar to when Lyft was like off by moving a decimal point on their guidance. Right. And it's like, oh, wow, you guys are making errors. We're all human at the end of the day.
That's so true. We are still all human, at least for right now, before the robots take our jobs. But let's take a look. I mean, NVIDIA, et cetera, the rest of the chip stocks don't really know what to do with it right now. You have Intel down, but that's because of Intel-specific news. Let's talk about some good news, though, and that's what we're seeing in the airlines this morning.
Yeah, airlines rallying this coming after United really beating expectations across the board. Stock up right now about 10%. Trading now at the highest level since February 2020. That's providing a lift to the likes of Delta, to the likes of Southwest. We're seeing the entire S&P 500 airline index rallying. The big news also, United now is going to bring back buybacks. So up to $1.5 billion, potentially $500 million in buybacks this year. So finally getting back on track, because it's been quite some time. They had to halt that back in 2020 during the pandemic. So seeing consumer trends staying stronger than I feel like people were expecting.
I guess, you know, to me, that's always a signal that there's nothing else that they can do to make money. There's no innovation.
Well, it's also, you can't acquire companies, really, and that's what we saw with the attempt to buy Spirit for JetBlue.
And Spirit, yeah.
Right.
I'm looking at the banks, at Morgan Stanley. Sonali just said it like 1,000 times to Ted Pick, but their shares are soaring on a day when their trading revenue was up 13% and profits were up 35%. That sounds good, except for yesterday, Goldman Sachs had profits up 45%. Citi had its best quarter of trading revenue, I think, in a decade, right?
Yeah.
And those stocks were both down. Citi was down 5% at the end of yesterday. Why is the market giving this to Morgan Stanley today when it took it away from Goldman and Citi yesterday?
I don't know. Am I allowed to say I don't know? I feel like it's hard to read.
Yes, you should. I think more people should say I don't know.
It's hard to read the tea leaves and say why one company does or doesn't get credit for certain things. The thing, Matt, on intraday basis, again, that stands out when I look at Morgan Stanley trading today, we're almost at 10 million shares traded.
Right.
When you look at what is typical on an entire day over the last month, 5.5 million shares.
Wow.
So a lot of volume rushing into that trade, again, trading at all-time highs.
All right, Bailey Lipschultz, we have to leave it there. Hope to see you again soon. That, of course, is Bailey Lipschultz. And coming up tomorrow on Open Interest, Robinhood CEO Vlad Tenev joins us in the C-suite. This is Bloomberg.